why don't we start revising what we have learned before yesterday on the capital structure theories. Did I correct the answer or problem set in question number 10? Did I have done it? Question problem set. Question 10 or question 11? So I have already corrected until question number 10, 10, 11. Okay. 10, 11 have been already done, or I haven't done it yet? Already done. Okay. Perfect. Question number, okay, if I show you this, so the question for the people who miss it. So question number 10, okay, so we calculate the unlevered cost of capital with a 13.6%, where if the cost of debt can, enjoy interest tax shield, so the effective cost of debt reduced to 4.8, so therefore the RWAC with tax will go down from 13.6% to 12.96%. For question number 11, I remember someone asked me a question. So let's go quickly. So if I have the free cash flow in 1 year, 90,117, so we know already that present value of unlevered equity cash flow is 90,000. I check that I discount it with the project cost of capital, which is 15%. So therefore, in this one, the present value of unlevered equity cash flows, unlevered, so which is the firm present value of expected cash flow will go to 90,000, right? So 90,000, if I borrow 30,000, I take the Monty-Miller proposition number 2. So I can get the RE equal to 20%. Okay, 20% is moving up from the RU. RU is 15%. So this RE goes up. Why? Why is going up? Why RE going up? Why RE is going up? Why the RE going up from 15% in case of no debt to 20% when there's the borrow 30,000? Why is that so? Why the RE is going up? Why the RE goes up? Not because the equity holder gets the cash flow from the after the debt holder. Okay, the RE goes up because anyone help me to answer why the RE go up? Because why the RE go up? From 15% to 20%. So why is going up? Why RE goes up? Anyone can? It's not because equity holder get the cash flow after the debt holders. No. The RE go up. The RE goes up because of what? Yeah, because they have more debt. Why has more debt? And you need RE, or because you have higher financial risk because the risk is higher. to levered equity holders. Perfect. Because the risk is higher, the increased risk due to the, you remember how we measure the risk, right? Because the cash flows that, you can see here, right? The cash flows, the return when the economy going up or strong or weak, okay? The 40% minus 10%, the risk is lower than 75% and minus 25%, right? In this case, we have only 2 points, right? So if I take the sensitivity of the return, you can see that the debt holder has 0 sensitivity on return if we measure in terms of the delta R, right? So, but you can measure in different ways. So the unlevered equity holders, when you have no debt, you can see that the return sensitivity that is a proxy of systematic risk here is 50% when you increase your debt, okay? When you borrow 500, and therefore the return sensitivity, the risk, okay, is higher, okay? The increased risk, okay, comes from the capital structure choice where the company decided to increase the debt, right? To have leverage, okay? Because the risk is higher, so therefore the lever equity holder requires additional risk premium to compensate the increased risk of 5% in this case, right? That is how we compute and then understand it, right? So what is the project weighted cost of capital? And you can calculate it directly, or you can say that in the Morgan Miller, perfect capital market, the R of the project should be equal to the RU should be equal to 15%, right? So let's go to the question number 12. What is the question number 12? You want to invest in IFO Corporation that has common stock with a market value of 200 million and debt with a value of 100 million. Investor expect a 15% return on the stock and 6% return on debt. Assume perfect capital market. What is the current company's weighted cost of capital? Okay, so it's very straightforward. What you have to do is just calculate the RWAC. RWAC we're gonna be divided by D plus E multiplied by RD plus E divided by D plus E multiplied by RE, just only the weighted average. So what is a 200 million? What is a 200 million? Okay, let's read and then we write. Let's write it. Can you just follow me? Okay, what is the, oops, you cannot hear me more. You can hear me now? Okay, now, okay. So it was interrupted for a while. Okay, so you can hear me now. Perfect. So what is the 200? 200 is the E equal to 200. You read and then you write. Okay, so then what you can read, you can write. So we have 100 million, debt with the value of 100 million. What is that? D equal to 100. Okay, perfect. Then what you have to write? Investor expect 15% on the stock. On the stock, that it should be the RE equal to 15%. Perfect. What is the 6%? 6% is the RD equal to 6%. Okay, and then you can calculate the RWAC directly. Okay, the RWAC will gonna be equal to the RU, which is equal to which is equal to 12%. Perfect. Thank you. So if the question number A, the current weighted cost of capitals is 12%. Question number B, suppose the company issue 100 million of new stock to buy back the debt. Okay, they issue new equity of 100. So what is the expected return of the stock, equity cost of capital after this transaction? Okay, so the new E would gonna be equal to 200 plus 100, which is equal to 200 plus 100 equal to 300. Okay, so of the 300, okay, which is the value of firms, okay, we're gonna make the D equal to, after this refinancing, the D will gonna be equal to 0. So without calculation, you should be able to calculate that 300 divided by 300 multiplied by what? What should be the RU? The RE will gonna be equal to the RU. We're gonna be equal to 12%, which is the case where we are the company is finance everything by equity, right? The RU goes down. Why the RU go down? Why the RE new go down? Why the RE goes down from 15% before refinancing, okay, go to 12%? Because why the RE go down? Why the RE goes down? Because anyone? Why REs go down? Does it make sense that RE goes down? Because debt increase and the risk is decreasing, right? So if the risk to the equity holder goes down, so therefore required rate of return of the unlevered equity, because the equity right now has 0 debt, so therefore the risk decrease, therefore they require lower return. In case of having 100 million of debt, they require 15%. Now there is no debt anymore. The the equity cost of capital goes down to 12%. So therefore the RE would gonna be equal to the RU is equal to 12%. Is this clear? Any question? Okay, this is too simple because this one we assume perfect capital market. When you see the exam and then I say that assume perfect capital market, it means that you forget about the tax shield. Okay, suppose instead iPhone issue 50 million of debt to repurchase stock. Okay, so if they decided not to issue new equity but rather issue new equity, okay, issue new debt, sorry, of 50 million to repurchase stock. All right, if you know what is a repurchase stock? Somebody know what is a repurchase? Sometimes, for example, when the company do the dividend payout, sometimes they can pay cash dividend, but sometimes they can also do a share repurchase. Okay, it means that you buy back, okay, a stock buyback. You buy back the stocks from investor. Okay, the number of outstanding stock after share repurchase will go down. That makes sense? So you can do the share repurchase if the risk of the debt does not change. Okay, because you increase your debt, maybe the debt holder may adjust based on the default risk, okay, the risk that the debt holder will bear. Okay, let's assume that the debt does not change, the risk of the debt does not change, so therefore the RD you still keep it as 6%, right? So what is the expected return of the stock after this transaction? Okay, what you have to write is you're gonna use what? Modi-Miller proposition number 2, where the RE will gonna be equal to the RU plus D over E multiplied by RU minus RD. What is the new D? The new D will gonna be what? The RU would gonna be equal to 12%. The RU should not change. The D should be equal to, you issue new 50, you have already 100, so the D would gonna be 150. Perfect. And the E should go to, what is the value of the E? The E will go, you repurchase, so you have already 200, so if you have 200, okay, minus 50, so the E will gonna be 150. Perfect. So therefore, you know RU, right? So the RE equal to the RU plus D over E, RU minus RD. All right. So the rest is simple, isn't it? So the RE will gonna be equal to 12% plus 150 divided by 150 multiplied by 12% minus 6%. So you're gonna get the value of, how much you get? 150 over 150 become 1. 12 minus 6 is 6%. 12% plus 6%, how much we get? How much we get? The RE? What should be the RE? Tong Ui Tan? 18%, thank you. Okay, this is example of I have seen from my teaching experience. It seems like you understand everything, calculate the calculation, everything is perfect, but sometimes we don't know why 14 come instead of 18%. This is a common sometime mistake. We don't know where it's come from, but it is often all the time. So please check your answer before during the exam. Okay. Now, any question? Is it clear? So you can deleverage, you can leverage everything. Okay, the company, when they have level of debt, you have the D. If you want to deleverage, it means you can, assume that you gonna get only the E without have any D. We call deleverage. You're gonna be able to get the RU, and once you get the RU, you can calculate the rest, and so on and so forth. Okay. All right. So if I show you, let me check whether it's okay. The RE, RWAC equal to 12%, RE equal to the RU 12% for question number B. Question number C, the RE equal to 18%. All right, perfect. Not complicated. Question number 13. Your firm currently has 100 million in debt outstanding with a 10% interest rate. The term of loan required the firm to repay 25 million of balance each year. Suppose the marginal corporate tax rate is 40%, and that interest tax shield have the same risk as the loan. What is the present value of interest tax shield from this debt? Okay, so the present value of interest tax shield over this period. So okay, the outstanding loan, the loan is amortized, isn't that right? So many of you work in the bank, you know how the amortizing loan means. It means like each period, okay, I gonna have the outstanding debt, okay, reduced of 25 million. It means I reimburse the principal of 25 million plus I pay the interest. Okay, so my debt outstanding goes down from 100 at the year 0, 75 in year 1, 50 in year 2, year 3, year 4, and so on, right? If I calculate this, I can be able to calculate that if it's 100, this is the beginning of the year. So if I have 100 outstanding with a 10% interest rate, it means that in year 1, I pay 10 million of the interest, okay, and 25% I reimburse. So I pay to the bank 35 million, right? For the period number 2, I gonna pay 25 million plus 7.5, where the 7.5 come from is the 10% of 75. Same for the year 3, okay, I pay 25, and then after I pay 25, my outstanding, I gonna pay interest from the beginning of the previous period to the end of the year, which is go to 5 and 2.5 like that. If I have interest payment at the year 1, which is 10, 7.5, 5, 2.5, I gonna be able to calculate the present value if I use the 10% discount, right? The tax shield, if assume that they have the same risk as the loan, so I can calculate the tax shield first, the 40% of my interest, right? 40% of 10, 3 over, okay, 40% of 7.5, like that, and then I calculate present value. The present value of interest tax shield after I discount it with 10%, I get 8.3 million US dollar as the present value of interest tax shield. Okay, this is how the the company can save the money or enjoy interest tax shield due to this 100 million outstanding loan. Okay, with the loan schedule as you can see here, right? That is the question number 13. 14 is a little bit more complicated, okay, but it's not too complicated. All right, so anyone have done question number 14? So Acme Storage has a market cap of 100 million, debt outstanding 40 million. Acme plan to maintain the same debt equity ratio in the future. The firm cost of debt is 7.5, corporate tax rate is 35%. If Acme's free cash flow is expected to be 7 million next year, and is expected to grow at the rate of 3% per year, what is Acme weighted average cost of capital? All right, so if you have the free cash flows of 7 million next year, so what you can do is you can apply the Gordon Shapiro model, where the the value or the company value should be equal to free cash flow, which is 7 divided by R minus G, and these R represent the R WACC, okay, because expected cash flow is a company free cash flow. I can discount company free cash flow with the company cost of capital, which is the ACME's, where the WACC, the WACC. So what is the RWACC? The RWACC should be what? Now they ask you what is the RWACC, right? So to be able to do so, what you can do is you can first of all calculate what is the value of the firm, right? What is the value of the firm? The value of the firm should be what? What is the value of the firm? What is the enterprise value for this company? What is the value of the firm? Of the value of the firm, let's write it as the VL. Value of the firm should be D plus E. What is the value of the D? Value of the D is 40 plus the value of E, which can be 100. So I have 140 million, okay, should be equal to my free cash flows, okay, my value of my this was gonna be the free cash flows divided by R WACC, okay, minus G. Okay, let's take the Gordon-Shapiro model, okay, where I have the expected growth of the free cash flow, which is the G equal to 3%. So I'm gonna be able to get 140 equal to 7 divided by R WACC minus 3%. Okay, 7 divided, no? 7 divided. So therefore, my RWACC should be equal to, the answer of the question, 8%. Thank you, Quoc Down Fund. Perfect. The RWACC should be equal to 8%. Is it clear? You have any questions? So I have my value of the firms, okay, which is 100 plus 40. I have 140. 140 should be equal to the company free cash flow at the year 1 divided by R minus G, and therefore I can have the RWACC equal to 8% from these solving this equation. Okay, what is the value of company interest tax shield? Yeah. So remember our formula where I have the word with tax. Let me take, where is that? Work. Yeah. So if I have the work should be equal to the pre-tax of work pre-tax minus D over D plus ERD multiplied by the corporate tax rate. Okay, I take this equation. All right. So if I take this equation, I'm gonna be able to get that the RWACC pre-tax should be equal to the RWACC plus D over D plus ERD corporate tax rate. So I have the RWACC, which is 8%, right? If it's 8% is the RWAC with tax, right? So if I want to know the RWAC with pre-tax, I can plus D over D plus E, which is 40 divided by 140, multiplied by the RD, which is 7.5%, and the corporate tax rate of 35%. So I get the RWAC pre-tax of 8.75. So if I have 8.75, I'm going to be able to calculate the VU based on the RU, right? So I have the RU right now, which is 8.75%. I can have 7 divided by R minus G, which is 8.75% minus 3%. So I have 120 million. So if I have the 120 million, which is the VU, VL is 140. The VL 140 minus 124 million. So I have 18 million, and this 18 million should represent the present value of interest tax shield. Okay. So question number 14, everything is fine, you guys. So I hope it's okay. So question number 15, I can go quickly. Okay. So I have a lever. You can check my solution here. I can skip for the time being. So you can study by yourself. Let's go to the last one, which is the question number 16, and then I go to the new chapter. Question number 16. Hartman Enterprise currently all equity firm with expected return of 12%, right? So when you read this, what is the 12%? When you read it, it's 12% is what? What is 12%? Hartman Enterprises is currently an all-equity firm with an expected return of 12%. It is the, what is the 12%? What is the 12%? All equity, all financed by equity. We called it the RE, it can be both, right? Lever or unlevered. When you have unlevered, it means everything financed by equity, which is known as the RU. Thank you. So is the RU equal to 12%? Perfect. If the RU equal to 12%, it is considering, a company is considering a leverage recapitalization in which it would borrow and repurchase existing shares. So it's almost like the question number 14. So my exam in the capital structure and strategy on this class, obviously you're going to have this type of problem. Okay. The what? Suppose the company borrows to the point that the debt equity ratio is 0.5. With this amount of debt cost of capital is 6%. So what will be the expected return of equity be after this transaction? Okay. So if there's nothing, you know, putting on tax and all that, you can assume the perfect capital market. All right. But most of the time I precise it. Suppose the company borrowed to the point that D over E is 0.5. So you can write what? What is 0.5? Is a D over E equal to 0.5. So what I can write it, I can write RU equal to 12%, isn't it? I read and I write. I don't know how to read, I reread. After I reread, I try to write. So 0.5, it should be D over E equal to 0.5. Perfect. With the amount, the debt cost of capital is 6%. So I gonna have R what? D equal to 6%. Okay, so the question is what it should be the RE after the transaction. RE is equal to what? If the RU is 12%, D over E is 0.5. I don't even need to know what the D, what the E, but I know that the DE, the gearing ratio, is 0.5. RD is 6%. So I should be able to apply what? MM proposition number 2, where it says that the RE should be equal to the RU plus D over E multiplied by RU minus RU minus RD. Okay, so I can just simply I can just simply plug it in. I have 12% like Quan Anle wrote it for us. The 12% plus 0.5 multiplied by 12 minus 6%, so I get 15%. Second question, suppose instead Hartman borrowed to the point that the debt equity ratio is 1.5 with the amount of debt. Hartman debt will be much riskier. As a result, the debt is cost of capital will be 8%. The RD go up to 8%. What will be the RE in this case, right? The RE equal to what? Very straightforward. So I have what? The RU remain unchanged, which is 12% plus 1.5, which is my debt to equity, multiplied by 12% minus 8%. So I have the final of my new RE goes up to 18%. I suggest you that after you calculate, you can just, have a look on your answer and try to think, does it make sense? Does it make sense? The RE in the case of B, of question B, should be higher or lower than question A. Obviously, the question B, since the debt equity ratio increased, it means the debt increased, so the risk to the equity levered equity holders should increase. So therefore, the RE of the question B should be bigger than the question A, right? So it's going up from 15% to 18% in the case of question number B, when the debt equity ratios goes up from 0.5 to 1.5. A senior manager asks you that it is the best interest of the shareholder to choose capital structure that leads to the highest expected return for the stock. How would you respond to these arguments? A senior manager argues that it is in the best interest of the shareholder to choose the capital structure that leads to the highest expected return for the stock. How would you respond to this? Anyone? You can type, you can talk. When the manager said that, okay, this is the best interest to the shareholders to choose the capital structure that leads to the highest expected return for the stock, how would you respond to this argument? Anyone? In general, in the exam, when I ask this type of question, I have less points from Asian student because sometimes the Asian student, we don't know how to write it, how to answer, even we understand it. But we ask to calculate, the Asian people, students, they calculate perfectly well. But when we ask why, and when we ask what is your response to this argument, you don't know how to explain it. So anyone, example, Guak Don Fund, you are trying to type. YRE increase on average. This increase is necessary to compensate shareholder for additional risk they are taking. So the return does not increase at the results. Okay. So return are higher because risk is higher. So return fairly compensates for the risk. Therefore, there is no free lunch, right? So the increase is to compensate the higher risk. So therefore, if the managers, okay, argue that they should try to, borrow a lot. So in that case, the higher they borrow, the higher debt they issue, the higher expected return to the stockholder. Obviously, the stockholder may also, not may, they also, bear a higher risk. So it depends on what shareholders want, right? The shareholder may want the company to take a reasonable risk level. Okay, we don't want the company to be excessively leverage because the risk is too high. So therefore, you're gonna have the financial distress cost and so on and so forth. So, all right. So this is the return are higher because risk is higher. Okay, very simple and straightforward. So I'm done with the questions. Problem set. The capital structure would be one of the main part in our exam. So any questions? So far so good. If you don't have any question, I'm gonna go and continue. We have already talking about this. Then we have also talking about the financial distress cost. Financial distress cost is direct cost and indirect cost. Okay, the direct cost is the cost of bankruptcy. The indirect cost is the cost of financial distress. Okay, that you can lose your customer, lose your supplier, lose of your employees, and so on and so forth. So therefore, the trade-off theories explain us that the choice of the capital structure should be considered as a trade-off between the benefits, which is interest tax shield, and the associated cost, which is the financial distress cost. Okay, the idea that we would like to know is try to find out what it should be the optimal. If you look at this graph, you can see that the level of D star should represent the level where the firm value or the VL is the maximum. Okay, so you can see from this line is a line where you gain the interest tax shield, and the loss of financial distress cost, we're gonna bring the net value goes down. Okay, you can see that if the associated cost of financial distress go is too high, so therefore it's not necessary that you go to the point of the D that you maximize it. The point that you can optimize is a D star. D star should represent the peak of this hill. You can see here that is for one firm, which is the violet one, and also another firm may have different D star, right? D star will depend on the firm, on the business they run, on the industry they run, and the potential cause of financial distress that may different by the nature of the corporation or the business they run. Okay, so if I have the green one and the violet one, what I'm interested is about the D star. The D star with of the violet one is higher than the D star of of the company with higher distress cost, right? When you have low distress cost, so your debt capacity will be bigger than the one that you have with high distress cost. Okay, and the distress cost, remember last time we discussed that is depend on two factors. One is the probability of default, the probability of financial distress, depend on likelihood that a firm will default. The increase with the amount of firm liability, it increase with the volatility of the firm cash flow. Remember, we're talking about the startup company. The probability of financial distress of the startup company should be bigger than the mature company. Why? Because the volatility of the firm cash flows of the startup company is bigger than the mature company. If I ask you this question, the startup company, I have two companies. One is startup, another one is mature company. Which color represent a startup company? A startup company should be green or violet? The startup company should be green or the violet? I will send you, I can upload the problem set after the last question of question number 17. Okay, I give you all those. Violet, the startup company, okay, should be, let's assume that the magnitude of financial distress cost is the same. Which company will have a higher probability of financial distress? Which company should have higher volatility of the cash flows? Right? The higher volatility of the cash flow, you increase the high volatility of the cash flow, increase the probability of default of financial distress. So therefore, the distress cost for the startup company should be smaller or higher? Higher distress cost, yes. Higher distress cost should be the green one or the violet one? Violet one or the green one? The distress cost is higher. The startup company, the D star of the high distress cost firm. So the distress cost firm of the startup company should be higher or lower? Should be higher, right? Startup has higher probability, higher volatility, for example, or volatility of cash flows. So I have higher volatility of the cash flows. Higher volatility of the cash flow will lead to higher probability of financial distress. So higher probability of financial distress. So it means if the magnitude is the same, you have higher probability of financial distress, and therefore your startup company should have a higher financial cost. So if you have a higher financial cost, the D star, which is the optimal debt level, should be of startup, should be smaller or bigger, or higher or lower? Should be obviously lower, right? The D star of the high financial distress cost should be lower. of D star of the low financial distress cost. Okay, so therefore it should be green or violet. I still have to answer. It should be green or it should be violet. Tang Chun Tan, you say green. Guyan Hong Lian Bu, you still keep at violet. Tang Chung Tan, you still keep green. What it should be? It should be green or it should be violet? It should be green. So therefore, it should be green. It should be green because a firm with high distress cost, the optimal D star should be lower than comparable firm with low distress cost, right? So therefore, your D star of the startup company usually is smaller, okay? Therefore, most of the startup company, they finance with banks debt or not? So the startup company often use bank debt to finance their business? No, right? So the banks, they will have less, they're gonna use less bank debt. Most of the startup company, they finance is by equity, right? So if you set up the new business at the startup, okay, you can probably start by, if you don't have money, where you can get your equity? How the startup get the equity? They cannot go to the bank. If they have no money, what you gonna do? Come to see Professor Bunkan Wanisha to get the money? The answer no, because your professor is also poor. Okay, they raise fund from investor. Ask father to money. Yes. Okay. If you don't ask your own father, you go to your father-in-law, right? Because your father-in-law is richer. No? You ask your wife. Okay. If your wife cannot, you go to your father-in-law. Okay. So if your family member cannot finance, or your startup company, you go to the Silicon Valley, you get financing. Okay, you go to first round of, okay, excellent. You can go to angels. Everybody know angels, right? Angels are investors who invest or who search or try to finance to help entrepreneur, engineer, people who have ideas to set up the business, to do R&D, to do some of those, fundraising to help those. Okay, after the angel, you can also go to the venture capital, right? Venture capital funds. They can be funds managed by the VC. They call the VC partners, or some of those VC, they also finance those startup companies. So all those angel VC, all that, they're investing in the equity, not debt. That probably explains what we are discussing today about capital structure. Why the nature of financing of very high risk or volatile company or business cash flows, usually you should use the debt or equity than debt, right? Because if you use debt, the volatility of your cash flow may make you in trouble, or your debt schedule for your debt obligation to pay. So therefore, having an equity, okay, you have less pressure from financial distress. Okay, so therefore, most of those startup company, by its nature of the high volatility of the business cash flows, so therefore you go for equity instead of debt. All right, perfect. Now, what is the optimal capital structure? I repeat one more time. The capital structure, the cause financial distress, reduce the value of lever firm. The amount of reduction increase the probability of default, which increase the debt level. So the trade-off theory says that the firm should increase the leverage until it reaches the maximizing level. The tax savings that result from increasing leverage are just offset by the increased probability of incurring the cost of financial distress. With higher cost of financial distress, it is optimal for the firm to choose lower leverage, as I explained to you, right? The trade-off theory helped to resolve two important facts about leverage. The presence of financial distress costs can explain why firms choose debt levels that are low to fully exploit the interest tax shield. Differences in the magnitude of financial distress costs and the volatility of the cash flow can explain the differences in the use of leverage across industry that I have just explained to you guys. Okay, so next, obviously you have one major benefit of having debt in your capital structure we call the interest tax shield. You have one of the major financial distress costs that you know that associated with the use of debt, and the gain and lose from these benefit and cost, we call it the trade-off theory. And this trade-off theory explain that the company should have their optimal capital structure, the optimal debt level, the D star that you maximize the value. Okay, so but in real world, a lot of people, many researchers also find out that debt does not provide only one benefit, which is the interest tax shield. They may also increase or give another type of benefit. For example, debt can help to reduce the agency cost. What is the agency cost? The agency cost is the cost that arise when there are conflict of interest between stakeholders. And one of the major agency costs that we learn in corporate finance is about the conflict of interest between manager and the shareholders. It had been found out that the manager, okay, who has their own private interest in running a company, that not necessary that the manager will make a decision that maximize the shareholder value. So we call it as managerial entrenchment. The manager often owns share of the firm, but usually own very small fraction of the outstanding shares. So therefore, manager, run a company on behalf of major share or major of the shareholders. The shareholder have the power to fire manager, but in practice, they rarely do so, right? So to be able to minimize the agency cost, okay, they it show that the debt can help to improve the the agency cost, to reduce the agency cost, right? So as I told you, manager they make decisions that benefit themselves at investor expense. They may reduce their efforts. They spend excessively on perks. They engage in empire building, that they can engage in the negative NPV project, and so on and so forth. If decisions have negative NPV for the firm, they are a form of agency cost. That can provide incentives for manager to run the firm efficiently. Ownership may remain more concentrated. Improved monitoring of management, since interest and principal payment are required by the debt contract. If you miss your interest and principal payment of your debt obligation of that you agree with the lender, you are in trouble if you don't meet those requirements, because therefore that reduce the fund available at managerial discretion to use faithfully. Before manager can use it badly, the payment of the debt may reduce the free cash flow in the firm, so that the manager will try to manage a company in such a way that the cash flow always meets the debt obligation. So therefore, debt provide another advantage in reducing agency costs. Okay, that is, this theory actually provide in the market and a new kind of operation which is known and very successful in advanced country. I'm not sure whether you have a lot in Vietnam or in emerging country, but you have a lot of transaction of the LBO. Have you heard something about the LBO? The LBO actually is starting from the agency cost of and debt relationship that I just explained to you, right? The LBO represent the leverage buyout. What is a leverage buyout? What is a leverage buyout? What is a buyout? What is a leverage buyout? Teacher Dong Guyen, can you explain more? What is a leverage buyout? Remember, debt can provide something called disciplinary role that help, that incentivize manager to run the company more efficiently, right? If the manager can use the free cash flow faithfully to do some empire building, to do some perks, to have the private jet, to subscribe in a very expensive club, and so on and so forth. The leverage buyout, which is the transaction, okay, that you make acquisition of your target company, okay, by using a big amount of debt. Okay, the LBO is the acquisition of another company using a significant amount of borrowed money to meet the cost of acquisition. Right. Okay, so who often do this kind of LBO? Who do an LBO? Who often do the LBO? Anyone knows? Someone know about the PE firms, PE funds? Yes, it's almost the opposite of the VC, right? The PE, they do a lot of LBO transaction. Okay, so the PE, which is the private equity firm, okay, they often make the LBO transaction. So they buy another company, can be listed or can be non-listed company, okay, and then they acquire those target company, and then they keep it and run this company for some years, okay, for several years or some years. And after some year where they can maximize the business cash flows and so on and so forth, they gonna exit. It means they gonna not buying, make acquisition of another company to hold it forever. They gonna do the exit. Okay, they have two ways to exit. One is you sell it to another company, sell off to another company, or you do what? You do the IPO. Is it right? So you can buy at 50 million US dollar for starting. Okay, you of those 50 million dollar, you borrow, $40 million or $35 million from the bank to get the bank loans. And this bank loan allow you to make acquisitions with a high level of debt. With a high level of debt, the PE firm, okay, has incentive to manage, to make a radical change in the company so that the company generate good cash flows to pay the leverage, right, that you have. So the debt will discipline the PE firm to restructure, to reorganize quickly, to manage the firm more efficiently so that the target company can produce enough cash flow to pay the debt obligation on the LBO transaction. But not just only to avoid financial distress of those company, you need also to manage those company in your portfolios to be able to sell that at a very higher price. So for example, if you acquire firm with $50, that I just give you example, when you do IPO, the $50 can go to $500 after the IPO. Okay, this is a very, very important business that this kind of PE are doing. Okay, normally which type of company PE could purchase the restructuring and sell back? Any type. But is some PE, they may have some specialization. For example, some PE, they are very focused on education. Some they are focused on PE, on high-tech firms. Some they can do many others. So it depends. So they have any type of business the PE can do on purchase and restructuring and sell back to the market. Okay, they do all type of transaction. Any type. Okay, this is in Europe, in the US. This is one of the big business in financial market, in the capital markets. Most of my students, after they graduate, they join investment bank, and many of them, they start working for those PE or VC firm, because most of these PE or VC firms, so they don't recruit only the young, but they recruit successful investment bankers. Okay, most of them, they can form some of those Goldman Sachs, the top BCG partners, they form those kind of PE, and then they manage. Okay, and then they obviously, one of the main part that they do is about corporate finance, of the valuation of the firm when they are going to acquire. But the same, when they are going to sell, they also needs the specialists to make the valuation. So we do a lot of valuation on these merchant acquisition and the exit. Okay, because the when you do acquisition, you do both sides, right? The seller and the buyer, right? And then you negotiate what is your, can be the agreed price, okay, that both of party agree and make a transaction. But the original of the LBO, the original of the creation or invention of the PE, those kind of thing, it's come from the capital structure theory, believe it or not, right? So where the debt provide incentive for manager to run the firm efficiently. So obviously, they may have some other type of equity debt holder conflicts. The conflict of interest exists if the investment decision have different consequences for the value of equity and the value of debt. Most likely that to occur when the risk of financial distress is high. Manager may take action that benefit shareholder but harm creditors and lower total value of the firm. They may have also some agency cost for the company in this trade that will likely to default because of the excessive risk taking, because of under investment problem, and so on and so forth. They have some many other benefits, some many other costs associated with those level of debt that you can see here. The curve, okay, before the curve, you cannot go beyond the interest tax shield line. But if you have, reduce agency cost, the firm value may increase, okay, like that. That's why it go beyond the dashed line, and they can go up. And then you have also, you know, many other excessive risk taking under investment. It can be additional type of cost, additional benefits, and therefore the point where you're going to have the D star here represent the optimal debt level that make the company that you maximize the firm value of the company. All right, so this is a kind of major idea of this graphic. Okay, so the debt increase, firm increase, leverage too high, firm reduce, and so on. The optimal level of D star balance these benefit and cost of leverage. Okay, so last but not least, though, among these kind of benefit and cost I'm talking about, they have many other theories that explain the capital structure and explain the pattern of variation of capital structure that each company, each industry, decide. First, we call the pecking order theories. The pecking order hypothesis state that the manager, okay, they are not necessarily trying to, trade off between benefit and cost. They're gonna make decision on capital structure based on these pyramidal priorities. For example, in other words, manager first, they're gonna, prefer to fund investment using return earning. So your internal capital market first. If it's not enough, you borrow by issuing debt, and then you choose equity as a last resource. And this one we call the pecking order theory. Okay, they have some, research literature who provide the evidence on these pecking order hypotheses. And more recently, some people, especially in the US, they found that actually the capital structure theory is nothing to do with pecking order, nothing to do with the financial distress cost, interest tax shield, whatever. Everything is come from behavioral. The behavior that they found is called market timing. They said that if the managers know that the stock is overvalued, okay, because manager has more information than outside investors. If the manager issue new shares, they believe that the stock is overvalued. If the stock is undervalued, they cannot finance or issue debt or using the retained earning. So therefore, the capital structure, okay, the company has is accumulated decision making based on the market timing. And they tested in the US and they found some evidence to support this market timing hypothesis. Okay, however, the capital structure theory is extremely important in corporate financial theory in many aspects. However, the final or the capital structure that the most solid one or the one that people can still keeping investigating, they're still ongoing, and no one can tell what is the best capital structure theory that explain the financial structure of firm. So you can pick up some of this theory from practical world, but I would say that the first state of theory is one of the most popular one that we can use to understand the choice or the strategy of firm in the capital structure. All right. So, wow, I'm done. So this is all about capital structure theory, perfect and imperfect capital market. Any questions? So far, so good. I need an eye drop. My eyes become red again. Any questions? Otherwise, if you don't have, we can have a break. And then when we come back, we're going to go to the new module on the payout policy, dividend policy. Payout policy is one of the other major, financial strategy of firm, of the manager to make a decision whether you're gonna pay out the free cash flows to the shareholder, or you can keep it, or if you decided to pay out, you're gonna pay cash dividend, or you're gonna do share repurchase. Which type, if you choose payout policy, how that affect to the stock price, and how that affect to the stock price if you choose the share repurchase. All right, everybody's okay? Are you still with me, or you are eating, you are doing something else? Are you sure you are with me? Somebody laughing. Among those 48 people, 47 people, I 100% sure that some of you are doing something else during my my class. So I can confirm. Tang Gong Guyen confirm me that he's drinking Saigon beer. We are always with you. Don't worry. We are not sleeping. Yes. Okay. Thank you. Not sleeping. Okay. So let me know when you start sleeping, or when you sleep, I gonna tell you about the exam, and then everybody awake. If I say that I'm talking about the exam, you're worried about your exam, isn't it? Yes? No, you're fine. Okay, you are big. You are big guys now. So, all right. So let's have a break, and then I come back. I gonna go to the new module on the payout policy that would allow us to do question number 17, and then I give you solution on the platform. And then, oh, Tan Guan Tan, thank you for your kind words. I give you a bonus point because you are very kind. Your class is very interesting. Haha. Yes, it's interesting. Okay, so let's have a break, and then I come back. I gonna have my lunch, and then I come back. Okay, as always, I gonna give you the Eiffel Tower view. You see that one? Yes. Okay. See you, Eiffel View town time. This is true. All right. You love Singha beer. Okay. I miss Singha beer too. See you. I leave it. I mute. I stop recording. New module. Let me check your understanding in the very practical world. I think you often ask me the practical world. Okay, let's check whether you understand the concept well and how you applied it to the real world. Let's assume, okay, that your company, you are the CFO of your company, you are on this debt level. Let's assume that the D star is for example, 40%, okay? 40 D over D plus E equal to 40%. This is a D star. If your company at the moment it has the level of debt, the D, which is what 20%, for example, 20% of the total value. The D star is 40% over value. Your company is here where the D star is 40. Okay, how we get the D star in the real world? For example, you don't know what the D star, right? It's very difficult to find out what it should be D star, but you can find a proxy. For example, you can take the industry average of the D, okay, and then you try to find out that your company is where your company stand for in the distribution of all firm in the same industry. If you take the average, D star is the average industry, for example, which is 40%, and where your company is about 20%. Okay, if you take this graph, and this graph represent the relationship between the D and the firm value. Okay, let's assume that it is like this. You are in the rate point where you have 20% of your debt over total value. So it means that your company is what? Your company is under leverage, right? Under leverage meaning what? Meaning that your company can go to the D star is lower than your D star. We call under leverage, right? When you stand, you know, more than the D star, we call that your company is over leverage. If your company assume that your company, you observe the industry is about 40%, your company has almost the same type of business profile, the risk of the cash flow as the average of industries. Okay, you are not the just only startup in the company, you are already quite mature company in the industry. So you know that the D star is 40 and you are 20. So the question that we ask is that this company, when you are under leverage, you can decide, okay, or you can consider to increase your debt so that is moved from this red circle here, move to the D star level. That makes sense? And that one increasing debt will increase the firm value because you are not at optimal it yet, right? The benefit from having more debt will be, the marginal benefit should be higher than the marginal cost until you go to the level of the D star where you can maximize your firm value. Okay. However, if your company, okay, so therefore somebody may argue, like for example, if your company is here, right? So if it's on this, what color I can make green color, okay? When is a green color represent the level of the company of the D right now? You know that the D star is here on the left hand side, right? So the green company is what? How we call that one? The situation. We called it that the green position, the company is over leveraged. When it's over average, increasing debt would affect what? Would decrease, right? The more you increase, the increase more debt will even more decrease value. So issuing more debt, increasing debt will destroy value. Where when you are in under leveraged position, increasing debt would add value. So therefore, it really depends on what we are talking about, whether you should increase to gain more interest tax shield or not. It depends on where your company stands for in relative to your D star, right? The D star is the optimal capital structure, okay, or the optimal debt that maximize the firm value. Okay, so I often ask this in the final exam, your exam, okay, you should understand how to read this picture, how this picture can apply to the real world, okay, so that you can understand that increasing debt or changing your capital structure to having more debt, it depends whether it can create or destroy the value. It depends where you are in comparing to your D star. It's very difficult to know what is the D star, but we can use the industry average, or you can use some proxy of your comparable firms where the structure of the business risk or the risk of the cash flows are most similar to your company, and try to see where you should stand to see how you're gonna choose your optimal structure. Ideally, everybody should go to their own D star, right? So as it's shown here, right, the D star for the high distress card firm should be lower than the D star of your low of the firm with low distress cost. So you depend on your company, the situation of your company, to see where the D star should be where and how you're gonna arrange your capital structure in such a way that you can maximize the firm value. Is there any way we could self-estimate firm D star without market benchmarking? Yes or no? It depends on how much information you have. If you have like long history of your cash flows, so you can be able to estimate the volatility of your cash flow. You can predict well of your cash flows. You know your future opportunity of your investment, because if you use the historical data where your company may have different future project, that may not necessarily the same risk profile that you have in the past. Therefore, it's better to have market benchmark of your future project that would allow you to see how other people how what is the best estimation of your D star. But obviously, you can self-estimate your D star if you have, enough information. If you are able to predict your future investment or your future business risk, and therefore you don't need it. But in the real world, usually we should have also some kind of market benchmark, but you don't need to take all the company that you are interested in. You can find some when you do valuation. We also often refer to comparable firms. If you have comparable firm that is quite representative, that close to your business, you can use your comparable firms. Okay, so and therefore you can use that. But to answer your question, is there any way to do self-estimate? Yes, you can do it. Your D star based on your historical data, because you know how the company perform, how the company generates free cash flows, and so on and so forth. You can do it, right? But in practices, we do both. We do self-estimate, at the same time we do some uh, market benchmarking using some comparables. It's like the same when you do some, of ratio analysis. Everything is relative. In finance, everything is relative. All right. The risk is not absolute term, right? The risk itself is relative. Everything is relative. So therefore, having benchmark is always good, because in finance, everything is relative. When you say risk is high, we don't know is high in comparison to what, isn't it? your debt ratio is high in compared to your previous level of debt, that is can be one thing, but you still also want to know whether your level of D as compared to your competitors, where they have some interesting information that they perform well, they don't, has the financial distress and so on and so forth. Having benchmark is always a good way to use it, together with your self-estimates. All right. Obviously, most of the entrepreneur or the owner or the CFO, they have their own model to estimate the level of D star, but without using the benchmark, you may miss something, right? Because you are based on the only the historical data, your own data. Okay, right. Thank you for the question. Excellent questions. Any other question? Other question? Okay, if you don't, I will go to a new module on the payout policy. The payout policy, what is the payout policy? The payout policy is the policy or is the way a firm chooses between the alternative ways to pay cash out to the shareholders. Remember, when you buy a chair, you become a shareholder, right? So when you become a shareholder, especially common shareholder, you expect to get two things. One is dividend, another one is capital gain, right? So the part that where the company, so since you don't know how much dividend you're gonna pay to the shareholders, okay, so you may decide on how the company will decide. We're going to talk about here, right? So if you have free cash flows available to equity holder, we often call equity free cash flows, right? You have firm cash flow in the problem question number what? Question number 14, that is a company free cash flows. That's why you discount with the RWAC. When you do the equity free cash flow, you discount with the RE, right? The equity free cash flows, you have two ways to decide. Okay, if you're CFO or the CEO of the company, either you're gonna pay out or you're gonna keep it in the company. Okay, why you're gonna keep in the company? Because you're gonna probably want to keep it at the cash reserves to absorb some of economic shocks that you cannot predict, where you can also use those retained earning that you keep it from the company profit, the company free cash flow, for investing in the new project that you're planning to do it in the very near future. Otherwise, if you don't retain it, you're gonna pay out. Okay, and the proportion of your payout over total free cash flow, we call the payout ratio. Okay, so and if the retained earning that you plow back to the firm of your free cash flow, we call the plowback ratio, right? The plowback plus payout would going to be equal to 1. Okay, when you decided to make a decision to distribute the free cash flow to the shareholders, okay, it's on the payout here. You can still have another decision to make when you know what the amount you're going to pay out from free cash flow. Either you pay dividend to the shareholder in the form of cash dividend or share dividend, or otherwise you can do the share repurchase. Okay, repurchase shares. We can understand, explain you how we do so. Okay, let me explain you how the real world works. Okay, when a company like Microsoft, who decided to pay a special dividend to the shareholder in year 2004. Okay, what's happened in 2004? Because Microsoft, before 2004, they almost has, paid zero dividend to the shareholders. Okay, so when the company don't pay dividend, is good or bad? When the company don't pay dividend, is good or bad? It depends, right? So it depends on the investment opportunity. So if you have more investment opportunity, you may pay less dividend, or therefore most of those GAFA company or those the startup high growth company, they usually don't pay dividend because they have a lot of a lot of investment opportunity to use those free cash flows, that therefore they often don't pay dividend. Okay, so sometimes when they decided to pay dividend, it can give a bad signal, a poor signal, or a signal to the investor that the company may, stuck in finding some interesting positive NPV project to invest. So therefore it depends. The question of T. Dong, where may I just add when share purchase equity will increase? We come back that question in a minute. Okay, it's part of slide that I gonna show you. The dividend. Okay, let's for the people who have never invest or received dividend, I gonna show how it works. So at least here there are 4 important dates that related to the dividend payment. This is about the real data on Microsoft. Microsoft, the board of directors, the board declare a special dividend of $3 per share on the 20th of July 2004. Okay, they announced that they're gonna pay dividend of $3 per share to the shareholder. They announced it on the July 20th of 2004. That the declaration date would have less effect on the dividend payment, because the dividend payment is set that we call the ex-dividend date. It means buyer of stock on or after this date do not receive dividend. Okay, from the period of July 20th to the November 15. Okay, that from this onward, November 15, the buyer or investors who buy stock on November 15 or after, they won't receive dividend. Okay, because the dividend will go to the previous investor who hold the stock before November 15. The record date, the shareholder recorded by this date received dividend, which is the date on the record date, which is November 17, which is the kind of like the after the back office on the recording and so on and so forth. And then the payable date, the eligible shareholder receive the cash payment for this, the cash dividend payment of $3 per share on the 2nd of December 2004. These are kind of important dates of these Microsoft's special dividend. Okay, special dividend, it means that they pay in in a very special occasion. It's not a regular dividend that you take it from the from the normal profit. Okay, so this is a special dividend. Okay, let's go back on some of these choices, and the choice on the payout, on share repurchase, on the stock price. Okay, that is what you asked me. Let's take the example. Okay, let's assume that we are in the perfect capital market. Okay, assume that Genron has $20 million in excess cash and no debt. The firm expects to generate additional free cash flow of 48 million per share in subsequent years if the company unlevered cost of capital is 12%. Okay, everybody know what is unlevered cost of capital means, the RU, and RU should be equal to the RWAC, all right, is 12%. if the enterprise value of ongoing operation is the present value of these future free cash flows, which is about 48 million, right? The firm expect to generate additional free cash flow of 40 million divided by 12%. Let's assume that the value of this free cash flow will be constant until forever. So I can use the perpetuity formula. I'm gonna be able to calculate the present value of the future free cash flow of 400 million. Okay, 48 divided by 12% is 400 million. Including cash, general total market value, the total market value of firms is 420 million. Okay, now if the board of director is going to consider several ways to take these 20 million out from the firm, okay, because it's excess cash that they don't want to keep these 20 million, the board is considering two options: either use 20 million to pay $2 cash dividend for each of Genron's 10 million outstanding shares, or repurchase shares instead of paying a dividend. How this decision, this policy would affect the share price of the company, and how which policy would shareholders prefer? Okay. Now let's go for the first one. When you pay dividend, you have 10 million share outstanding, so therefore Genron will be able to pay $2 dividend immediately, right? Because you have 20 million, okay, to distribute, right? So 20 million, you have 1 million, 10 million shares, so you pay $2 cash dividend for each share, okay? So what happened is, because the firm expected to generate future free cash flow of 48 million per share, it anticipates paying a dividend of 4.8 per share each year thereafter. So if I take the general share price just before the stock pay its dividend, we call the cum dividend. The P-cum would gonna be current dividend plus present value of future dividend, that we can have 2 plus 4.8 divided by 0.12, which is $42 per share. Now, if company share price, what would gonna happen to the company share price after the stock goes ex-dividend? After paying the dividend, the value of the firm should goes down from $42 to $40, right? So you can have only the future dividend part after the date of the $2 paid. Okay, it's gonna be 4.8 divided 0.12. So therefore, the value of firm should move it, or the price should go from $42 to $40. In the perfect capital market, when the dividend is paid, the share price drop by the amount of the dividend when the stock begin to trade ex-dividend. As you can see from this, December 11, December 12, the cash is 20, other asset is 400. The 400, if you take 20 out, so the total market value of firm should bring down to 400, okay? After the dividend payment, if I have 100 million shares, so the share price should be $40 per share. Okay, that is the first policy. So far, so good? So far, so good, you guys? Yes? Hello, hello. Yes, good. So after, if I don't choose the policy one, I choose share repurchase. What would gonna happen? Share repurchase, suppose that Genron does not pay a dividend this year, but instead use 20 million to repurchase its share on the open market. How will repurchase affect the share price? When initial share price is $40, so General will repurchase 20 million divided by $42 per share at the market price at that time. So the company should be able to do share repurchase of 0.478, so 476 million shares. So meaning that after the share repurchase, the outstanding shares would be 9.524 million shares outstanding, isn't it? Right? So if it's that case, after the share repurchase, the before share repurchase is how the balance sheets look like. You have 20 for cash, other 400. The total market value of asset is 420. If you have 10 million shares, so the share price should be $42. Interestingly, that when you do the share repurchase, after share repurchase, the value goes down to 400 because 20 will be used. And then if the number of share you repurchase, the remaining outstanding share will be 9.524. If I have 9.524 divided by those total market value, the share price 400 divided by 9.524, you're gonna have $42. So what's the implication on this? It means that the market value of General's asset fall when the company pay out cash, but the number of shares outstanding also fall from 10 million to 9.524 million. The two changes offset each other so that the share price remain intact at the same as the $42. When you do share repurchase, it would not affect the share price. All right. In the future year, General expect to have 48 million in free cash flow, which can be used to pay dividend of 48 million divided by 9.524 million share, which can be 5.04 per share each year. So the share price today would be $42. In perfect capital market, an open market share repurchase has no effect on the stock price, and the stock price is the same as the come dividend price if a dividend were paid instead. Okay, so if I take the investor preferences, if you are investor, which one do you prefer, the policy 1 or the policy 2? Let's give example. If you assume that you hold 2,000 share of General stock. Okay, investor holding after dividend or share repurchase will gonna look like this. 2,000 shares, it means like, to $40 multiplied by 2,000, it means that you're gonna keep your value of the company in the stock, in the form of stock of 80,000, and 4,000 you get it for cash. Okay, and if you go for repurchase, you have 2,000. Since the share price remain at 42, so it means that you can keep $84,000 on in the stock of your 2,000 shares. Okay, so in either case, the value of investor portfolio is the same, remaining the same at 84,000 US dollar. Which one do you prefer? Which one do you prefer? What if the firm repurchase share but investor want cash? If you do one repurchase but you want 4,000 cash, so investor can do something called homemade dividend. It means that instead of doing this, you can sell at the market price, sell your share to get cash. So if you sell the amount of 95 shares, you're gonna get almost 4,000 cash, which is 3,990. Okay, that you can rebalance almost the same as they do the dividend. The company do dividend. You can do some homemade dividend if the company decided to do share repurchase, but you want to have cash. What if the firm pay dividend and investor does not want cash? The investor could use dividend to purchase additional share, and you can keep additional share at the $40. Okay, and then you can have 84,000 value in the stock, like the repurchase. Okay, so what is conclusion from this is mean investor preference. No, in either case the value of investor is 84,000. In perfect capital market, it says that investors are indifferent between firm distributing fund via dividend or share repurchase. It should not be matter. It doesn't matter, right? By reinvesting dividend or selling share, they can replicate either payout method and their own. Again, Monty Miller, who got the Nobel Prize, they don't put only the capital structure policy, but he also worked on dividend policy, which is called dividend policy irrelevant propositions. It says that in perfect capital market, holding fixed investment policy of a firm, the firm choice of dividend policy is irrelevant, and it does not affect the initial value of the firm, meaning that you pay dividend, you don't pay dividend, you pay dividend in the form of cash dividend, or you do share repurchase, it should not be relevant. Okay, it doesn't matter. All right, which is called the dividend irrelevant. Although the dividend do determine share price, a firm choice of dividend policy does not. A firm free cash flow determine the level of payouts that it can make to its investor. In a perfect capital market, whether these payouts are made through dividend or share repurchase does not matter. That is already explained to you under policy 1 and policy 2, where you have cash and dividend, and cash dividend and share repurchase, except when the market is not perfect. Obviously, you know the market friction, right? The government always a person who make the market friction. And one of the market friction, which is very important, is about taxes. The tax on dividend and capital gain. And investor may have different preferences if the tax on the dividends is different from the tax on the capital gain, right? Shareholder typically must pay tax on the dividend they receive, the capital gain tax when they sell their shares, right? Tax on dividend and capital gain. When a firm pays dividend, shareholders are taxed according to the dividend tax rate. If the dividend are taxed at a higher rate than the capital gain, shareholder may prefer share repurchase to dividend, and vice versa. This is example of the historical capital gain tax and the dividend gain, dividend tax. As you can see that dividend is very high, was very high in the 1971 to 1981, when the time where they want to promote the capital market in the US. And you can see that up to since 2003, the current tax rate on capital gains and dividends are or remain the same at the 15%. Okay, either a capital gain or dividend, they have the same rate. But in general, in the past, the dividend, the tax rate is much higher in the capital gain. Okay. Again, the optimal dividend policy with taxes, the optimal dividend when the dividend tax rate exceeds the capital gain tax rate is to pay no dividend at all. Dividend in practice, prior to 1980, most firms use dividend exclusively to distribute cash to the shareholders. And then little by little, and even more recently, the share repurchase become more and more popular. By 2009, about 30% of firms rely exclusively on dividend. Another 70, they either do share repurchase or they can make a combination of part of them is dividend, part of them share repurchase. The interesting, we call dividend puzzle is that even we know that the dividend tax rate is, you know, it provide a disadvantage, but firm continue to do dividend payment despite their tax disadvantages. And you can see here from the graph that, you know, the share repurchase, you know, alone, okay, is become, you know, increase, and the dividend only also, dividend and share repurchase is, you know, is almost like that amount, uh, one third, one third, one third. A little bit dividend is a little bit higher than one first than the dividend and repurchase. Okay. If you look at the dividend and capital gain tax, then you can see that dividend tax and capital gain tax are different. You know, in China, they're almost 20% for both. In Japan, dividend is higher than the capital gain tax, which is in general, it like that. And in France, you can see the dividend and capital gain tax are a bit different. In the US, is almost the same. And then Vietnam, where is Vietnam? What is the tax rate for Vietnam? What is the tax rate from Vietnam? Anyone can tell? Before I can tell, just let me finish the slide by give you the example of dividend and share repurchase, how cash is distributed to the shareholder. As you can see, that dividend you pay cash, and then share repurchase you buy back your share from the shareholder. Participation in the dividend is involuntary, so it means like once the company decided to pay cash dividend, everyone will receive the dividend. Okay, where the share repurchase is voluntary, shareholder choose whether to sell their share or not to the company. Okay, when they have the share repurchase program. Taxation for ordinary investor in general, you know, there are taxes as ordinary income by tax about 15%. Tax capital gain is also 15%. Effect on the share price: when you pay cash dividend, the share price drops, and when you do share repurchase, the share price is unaffected. Okay, because of the number of shares also reduced, so therefore the share price should, you know, can remain unchanged. Well, that's it for the payout policy. What is a dividend tax rate in Vietnam compared to capital gain tax? Anyone knows? What is the dividend tax and capital gain tax? What is the dividend tax? How much you have to pay the dividend tax? It is 5% for individual. Capital gain tax is 0.1% on gain. 10%. What is 10%, Ton? Chung Ton? What is the 10%? I have 5%, 0.1. I have 10%. What is the 10%? Because in France or in the US or in general, the tax rate is applied on the base of dividend received and the capital gain realized. Okay, so is it 10% for cash dividend? Is this what you said? Perfect. And how about the capital gain? Is 10% as well? 0.1% seem to be very small. Somebody says 0.1%. Uh-huh. 0.1% on the face value amount. Okay, it's not the gain. All right, so it's not the same base. So it's a 0.1% of the total face value you trade, right? So which is not the same. But if you lost your money, you lose your money, you still need to pay this 0.1%. If your capital gain is negative, you still pay. You buy stock at 100 and then you sell that at 120, you still pay 0.1. You still pay the capital gain when it's negative. Yes. Ah, okay. That is not a good deal. Because in most advanced country, in France or in the US, when your capital gain is negative, it means that you don't gain, right? You lose your money. So you don't pay tax on the capital gain. So therefore, 15% in the US represent the capital gains. When the capital gain is zero, you pay zero. Okay, so 0.1% applied to all. Either it's negative is a kind of like transaction cost. It's like a charge, right? It's like a fee. The government take it. Exactly. Okay, understand. But the dividend, you take it from the dividend received, right? So how about the share repurchase in that case? Dividend is 5%? Okay, so it's 5%. Okay, good. It's a 5%. How about the share repurchase? So the share repurchase is gonna be considered as the same as the 0.1%, isn't it? Because it look like almost close to the capital gain transaction, isn't it? So the share repurchase is based on 0.1 of the total face value. If I understand, yes, it's a chart on seller only. Okay, so I don't want to go to detail because each country may have different tax treatment, and also they also depend on the government on their policy to promote the capital market. But in general, as you can see from the graph, the capital gain tax usually is smaller than the dividend tax rate in general. Okay, because the company or the government want to promote people to participate more in the capital market. Okay, therefore they try to invite individual investors to participate more. But they have also some, I think the same for Vietnam, that the if you invest in the funds or in the company, they don't treat the same as individual, right? So just only to remind you some of this. Okay, so for the problem set before I give you all solution on the platform tomorrow. So you can have the question number 17 to go. Can you do the question number 17, please? Yes? You do it now or you're gonna do at home? You're gonna do later? Later or now? The answer is gonna be later. Yes? Because you're tired. I'm also tired. Okay, so today we finish again. I still have only one big module, which is about long-term financing to go with you. So we can still have class tomorrow, but since I missed one, we prepared on Thursday. I checked with Lynn. Maybe I may change it again on last one because my last session I'm planning to do the kind of revision for before your exam so that you have some idea how the exam look like and what are the main concept I can evaluate. So maybe if I cannot do Thursday, I may propose maybe one session in mid-September, something like that, or beginning of September to see a little bit later on so that we can digest some of those concepts you have learned in my class. And then I revise one more time so that you can, prepare your exam for since I haven't written the exam yet, so I can consult with Lynn and the CFVG team whether we're gonna do online or not, so that one I have more element on the exam that I prepare. I can come to see you my last sessions later. I think that is give you more benefits if I come to tell you later when I know how the exam look like, because at the moment I don't know how the exam look like, to tell you precisely how the exam looks like and how you're gonna prepare the exam. That makes sense? Is it better? No, I think it is better. So we're gonna have the class tomorrow, but I can still miss one class that I may confirm you later. Let me talk with Lynn after, okay, to see whether I maintain Thursday, but I think it's better to postpone it for my last session after I prepare the exam, okay? Because I'm not 100% sure how the exam will gonna look like, but I believe that this is online. And then I would think about how long it's gonna take, okay? And which form we can do the exam online, okay? That make you the best, okay? And then I think we can leave one session that we can meet together a few 1 or 2 weeks later before your exam, so that you have time to digest, because since you learn every day, and it's a lot when you learn all the time. Sometimes you can follow, some of you follow well, but maybe some of you may need more time to study a little bit. So you have all my slides, you have the solution of the problem set. I'm gonna give it to you tomorrow after we correct the question number 17 together, okay? And then I will confirm you with the date and explain to you what you need to prepare for your exam, okay? I only assure you that I gonna make it relatively easy, okay, so that everybody will pass. But I just need to have a kind of some difficult question to people who gonna get 20. Some people may need only 18, 17 or 10 to pass, okay? But I think you need a revision. I agree with Tong Nguyen. And then when you learn every day like this, it's more difficult to ensure that you understand everything. But I hope that we have a nice sessions together. Tomorrow is gonna be easy because it's gonna be blah blah blah, no calculation. I can explain to you a little bit about what is a long-term financing, what are other alternative financial instrument that people or the company can use, and so on and so forth. Okay. And then the last session on the revision, I can probably try to find some more exercise and maybe some previous exam for you to practice and so on. Okay. Is all right? Is okay? Are you happy? Yes, absolutely. It is great. Okay. Thank you. And today I finished grade again a little bit earlier. So I think it's time for you to relax as well. It's very late in Vietnam at the moment. And then stay safe from COVID and stay safe. And wish you have a great evening. Okay. And see you tomorrow again. Bye.